For over a decade, the cryptocurrency market operated on a predictable, retail-driven clock. Every 4 years, the Bitcoin halving triggered a massive speculative wave, followed by a punishing crash. As of 2026, that mechanical cycle is officially dead. Spot ETFs and corporate treasury allocations shifted the market's demand profile away from retail volatility and toward institutional consistency. Structural demand from global asset managers has replaced the periodic surges of retail FOMO. Today, the primary driver of digital asset valuations is macroeconomic liquidity. When the Federal Reserve maintained a restrictive, hawkish hold on interest rates at 3.5% in early 2026, it tested the resilience of this new market structure. The capital did not flee. Instead of acting as a speculative casino, blockchain proved it has graduated into a layer of operational financial infrastructure, capable of competing directly with traditional yields. This maturation gave rise to OnFi, or on-chain finance. OnFi is the new standard that explicitly merges the compliance and capital pools of traditional finance with decentralized blockchain rails. Through the massive scale of stablecoin settlement and the tokenization of real-world assets, or RWAs, OnFi is actively creating a unified global ledger for commercial transactions. The market's behavioral economics have decoupled from the Bitcoin halving. The industry has shifted away from narrative-driven speculation and is now focused strictly on business-to-business financial plumbing. Traditional asset managers oversee trillions of dollars under strict fiduciary duties. Before they could deploy that capital into digital assets across borders, they required absolute legal certainty. That certainty arrived through legislation. In Europe, the implementation of the MiCA framework established the first unified licensing system across all 27 member states, allowing institutions to operate across borders with a single compliance standard. In the United States, the passage of the Clarity and Genius Acts provided the exact legal definitions for digital assets and stablecoin issuance that compliance departments had been waiting for. With transparent custody and reporting standards formally codified, retirement funds and 401k plans were finally able to safely list regulated crypto investment products for their clients. This clear regulatory environment also sparked the rise of digital asset treasuries, or DATs. Public companies now regularly hold digital assets as standard board-approved treasury allocations. Regulation is no longer an obstacle to be routed around. It is the primary catalyst enabling mainstream financial integration and direct capital formation on the blockchain. It is time to retire the idea that stablecoins exist merely as fiat trading pairs for cryptocurrency speculators. This diagram illustrates the difference between legacy banking and on-chain settlement. On the left, a traditional cross-border business wire takes days and bounces through multiple correspondent banks, each extracting a fee. On the right, a stablecoin provides an instant, point-to-point transfer of digital dollars directly between corporate wallets. These internet dollars operate 24 hours a day, 7 days a week. They allow multinational corporations to automate complex operations like global payroll distributions and instant vendor payments without relying on banking hours. By 2026, the total supply of stablecoins has surpassed $300 billion. And virtually all of that growth is driven by this kind of enterprise plumbing. This volume has led to the development of native stablecoin economics. Native stablecoin economics is a structural shift where blockchain networks integrate stablecoin issuance directly at the protocol level, allowing the network itself to retain the issuance fees and yields generated by these massive transfers. By utilizing near-instant international settlement, businesses are unlocking billions of dollars in working capital that used to be trapped in transit within legacy correspondent banking networks. The next layer of this ecosystem is real-world asset tokenization. Backed by the leadership of traditional finance institutions, the digitization of physical and traditional assets has moved entirely out of experimental pilot programs and into full-scale production. Assets like U.S. Treasuries, private equity shares, and commercial real estate are now minted as digital tokens. This process makes traditionally illiquid assets tradable around the clock and allows them to be split into smaller fractional ownership stakes. This diagram shows the architecture of the OnFi stack. At the base, we have Layer 1 blockchains. Above that sits a privacy layer, followed by an asset layer holding these tokenized real-world assets. Finally, at the top, we have the application layer, where these assets are deposited into permissioned lending pools. Permissioned lending pools are compliant, decentralized credit facilities restricted to verified institutional participants. Traditional institutions deploy their capital into these permissioned pools to generate real-world yield. They are using tokenized treasuries as collateral to secure loans or earn interest, completely replacing the algorithmic speculation of early decentralized finance. To make this viable for enterprises, the stack relies on a specific technological enabler: zero-knowledge proofs, or ZK rollups. ZK rollups are cryptographic protocols that allow one party to prove to another that a statement is true, without revealing any specific information about the data itself. Corporations require strict transaction confidentiality. No enterprise is going to execute supply chain deals or proprietary trading strategies if that data is visible to competitors on a public ledger. ZK rollups solve this bottleneck. They allow institutions to utilize the security and speed of transparent public ledgers, while keeping the specific details of their financial operations entirely hidden. This structural shift drives massive volume back to established high-speed Layer 1 networks, like Solana and Ethereum, which process the underlying settlement of these confidential transactions. The OnFi stack democratizes access to historically illiquid assets, while elevating decentralized finance into a compliant, professional-grade parallel financial system. Beyond traditional finance, the blockchain is becoming the foundational layer for another rapidly expanding sector: the convergence of artificial intelligence and decentralized infrastructure. As autonomous AI software programs become more advanced, they face a mechanical problem. They need a way to pay for computing resources, data, and services without requiring human intervention or traditional bank accounts. This is the foundation of the agentic economy. The agentic economy is a financial ecosystem where autonomous AI agents interact and transact with each other directly via permissionless blockchain rails. These AI agents utilize smart contracts to execute instant micropayments. They automatically purchase API calls, compensate human workers for data labeling, or pay for automated web scraping, all governed by self-executing code. To support the immense processing requirements of these models, blockchains provide decentralized computing marketplaces, known as DePINs. DePIN stands for Decentralized Physical Infrastructure Networks, which allow individuals to rent out their unused GPU power directly to AI training projects. This automated economy creates a severe security challenge. Distinguishing a human user from a swarm of AI agents requires strict proof of personhood digital identity systems. Proof of personhood is a cryptographic verification mechanism that confirms a user is a unique, living human without exposing their personal data. Crypto is the only financial infrastructure capable of providing this combination of verified identity and trustless payments at machine-to-machine speed. Blockchain serves as the economic engine and settlement layer for the autonomous AI future. By 2026, the ideological standoff between legacy banking and digital assets is over. The two systems are merging into a unified financial architecture. Traditional finance brings massive capital pools, an established foundation of trust, and rigorous regulatory compliance frameworks. Crypto brings 24/7 global settlement rails, unprecedented transparency, and programmability. Global financial hubs have aggressively capitalized on this unified architecture to build borderless liquidity, capturing market share by integrating digital asset services directly alongside legacy banking operations. This maturation has forced a permanent shift in investment analysis. Capital allocation is no longer based on social media sentiment or hype, but on fundamental cash flows and sustainable economic models. Institutional money managers now scrutinize crypto projects exactly like traditional equities, valuing them strictly on protocol revenue, real user growth, and active developer engagement. We see this clearly with staking, which has become a default feature in regulated crypto funds. Regulators and asset managers have aligned to turn passive exposure into productive, income-generating assets automatically. The distinction between crypto and finance is rapidly disappearing as the underlying blockchain rails become entirely invisible to the end user. The digital asset market is now firmly established as the foundational architecture of 21st-century global commerce.